Welcome to the Explainer. Today, we're doing something a little different. You're not just the viewer, you're going to be the engineer, and we're going to solve a very real, very high-stakes business case together. So here it is, the big one. Your company wants to drop 169 million reais on a new project. Do you give them the green light? This is the exact dilemma facing the team over at Hyzen, a huge sugar and ethanol producer. They're thinking about expanding into a new chemical, butanol, and they need to know if it's a smart move. All right, so let's get into it. Your mission, should you choose to accept it, is to put on that engineer's hard hat. You got to dig into the techno-economic feasibility of this new butanol plant. Basically, is this a good idea or not? And then recommend a final decision to the board. No pressure, right? Okay, first things first. Any investigation like this has to start with the evidence. And in the business world, that means following the money. So let's kick things off by digging into the costs. And whoa, the very first number on our evidence board is a big one. We're talking 169 million Brazilian reais. That's the total capital expenditure, or CapEx. It's the huge upfront investment just to get the doors open and build this thing. So, where's all that cash going? Well, you can see it's split pretty much down the middle between the two main parts of the plant. A little over half goes to the fermentation unit. That's where all the chemical magic happens. And the rest goes to the distillation unit, which is all about purifying the final product. Okay, but building the plant is just step one, right? The spending doesn't stop there. You've got to keep the lights on, keep the machines humming. That's your operating expenditure, or OPEX. And for this plant, that's another 125 million reais every single year. And when you slice up that OPEX pie, something really jumps out. Look at that. Over half the annual cost, a whopping 56%, comes from just one thing, sugarcane. Add in steam at 30%, and wow, you can immediately see this project is going to be super sensitive to the price of some very basic commodities. Okay, we've tallied up all the costs, and it's a lot. So now let's look at the fun part, the potential payoff. Let's follow the money trail and see what kind of revenue this plant could actually bring in. And the projection? We're looking at a cool 147 million reais in total annual revenue. That's the money the plant is expected to earn each and every year by selling what it makes. So where's that revenue coming from? No surprise, the main product, butanol, makes up the biggest piece of the pie, 65%. But here's what's really key. You also get these valuable co-products, acetone and ethanol. Together, they chip in another 33%. That is a huge boost to the bottom line. All right, so let's recap. We've got costs, we've got revenues. Seems simple enough. Case closed, right? Well, not so fast. A good engineer knows the story doesn't end there. You've got to go deeper. I mean, on the surface, it looks pretty good, doesn't it? You've got 147 million coming in, 125 million going out. Year over year, you're making a profit. You're in the black. But, and this is a huge but, what about that massive 169 million real startup cost? That money doesn't just disappear. You have to account for it over the entire 20-year life of this project. So how does that change the whole equation? To figure that out, we need a special tool. It's called net present value, or NPV. The easiest way to think about it is like a final score for the entire project, from start to finish. It takes all the future money you'll make and all the money you'll spend and brings it back to today's value. The rule is simple. A positive NPV is good, a negative NPV is bad. And here it is, the moment of truth. After all the calculations, the 20-year NPV comes out to negative 18.7 million reals. Ouch. So even though it makes money each year, it's just not enough to pay back that huge initial investment. Based on this number alone, the verdict is clear. This project is a no-go. It's not viable. But wait. Just like in any good detective story, the first verdict isn't always the final one. The real world isn't a static spreadsheet. Things change. Prices go up, prices go down. We absolutely have to explore the what-ifs. And this is where things get really interesting. We run a sensitivity analysis, and what it shows is that this whole project is basically balanced on a knife's edge. I mean, look at this. If the price of butanol just inches up by a tiny 4%, boom, the project is profitable. Or if the price of sugarcane drops by only 6%, same thing, we're in the green. It's incredibly sensitive. You know, the Nobel laureate, Ilya Prigozhin, said it perfectly. The future is uncertain, but that is no reason not to prepare for it. And that's exactly our situation. We can't just cross our fingers and hope prices go our way. We have to prepare for this uncertainty. And to do that, we need a much more powerful kind of stress test. And that's where the Monte Carlo simulation comes in. This is a seriously cool technique. What we do is, we tell a computer to run our financial model, not once, but thousands of times. And each time, it randomly tweaks those key variables, the price of sugarcane, the price of butanol, based on their historical volatility. It's like playing out thousands of possible futures to see, on average, how often we actually win. So, the simulation is done. We've run 5,000 different possible futures through the computer. And now we have our final, most critical piece of evidence. This is the single number you, as the engineer, are going to walk into that boardroom with. And here it is, 40%. The simulation shows that the project has a 40% probability of achieving a positive net present value. Let that sink in. Out of all those possible futures, you come out ahead in 4 out of 10 of them. This is the ultimate takeaway from our entire investigation. So, now it all comes back to you. The evidence is on the table. A 169 million real investment. The potential for profit is there, but the odds, a 40% chance of success. As the engineer, what's your final recommendation? Do you give the green light and take the risk? Or do you tell the board it's just too big of a gamble? What would you decide?